Hello, this is Greg Giardino with It's Your Smarter Money, and I'm joined here today with Alison Hall. And today we're going to talk all about Medicare IRMAA, and we'll talk to you about what IRMAA is and some of these dreaded costs. So let's jump into this. All right, so what is IRMAA? IRMAA stands for the Income-Related Monthly Adjustment Amount. So what is that? Those are those pesky additional monthly Medicare surcharges that Medicare enrollees pay for Medicare Part B and Part D. Now, if you're signed up for Medicare Part A, this will not apply to you. It's for those that normally reach the age of 65 and they have to enroll into Medicare Part B, which is for doctor's visits and other different types of going to different outpatient visits as well. And what happens is it really affects those high earners. So if you're making a certain amount of money above certain thresholds, you will get assessed these monthly Medicare surcharges. And why should you care? Well, it can result in thousands of dollars in additional costs. So it's something you really have to pay attention to, and is something you have to plan around.
Everyone pays a standard premium of $174 per month when enrolled in Part B. Part D premiums can vary depending on your plan, but the national average comes in at around $35 per month. Depending on your income, however, you may trigger those additional surcharges that Greg just mentioned. This chart came directly from the Social Security Administration website, and it outlines the income thresholds and corresponding rates taxpayers are subject to. These rates are held against your MAGI, or Modified Adjusted Gross Income, which is your adjusted gross income with certain exemptions, excluded income, and deductions added back in. Now, I will point out that this chart is specifically for couples married filing jointly. The IRMAA brackets for a single filer start at $103,000, with the highest bracket being triggered at $500,000. So what this chart is saying is that if your modified adjusted gross income as a couple is between $206,000 and $258,000, you'll pay an extra $83 per month for Parts B and D. Skipping to the worst case scenario, if your income is above $750,000, you'll be charged an additional $500 per month. Now, this is per person. So we're talking about as much as an additional $6,000 for an individual or $12,000 for a couple in 1 year. This assessment is revisited annually, so just because you're subject to IRMAA in 1 year doesn't necessarily mean you'll be in it forever. What we often recommend when a client has unavoidable income, such as high capital gains from the sale of a home, is to overload that year to fill out your IRMAA bracket. You can withdraw additional funds from your IRA, do a Roth conversion, or recognize additional gains in an investment account. If you're going to be on the hook for additional premiums anyway, you might as well do what you can to reduce your exposure in the future.
So you need to be aware of this IRMAA cliff because it can be steep. So what do we mean by this IRMAA cliff? Well, as Alison just spoke about, there's certain thresholds you have to stay within in order to be assessed or not be assessed one of these Medicare surcharges. So if you're even $1 over that threshold that Alison just mentioned, well, guess what? Now your entire income that you made is now subject to that higher IRMAA tier. So you really have to pay attention to this. And there's a lot of these, what we call hidden IRMAA triggers, these stealth taxes, if you will. So any increases in your ordinary income, if you have any capital gains, if you have any other different various forms of income, those will increase your IRMAA thresholds. So for example, if you decide to implement a taxable Roth conversion, and you have pre-tax monies in an IRA or a retirement plan, and you want to move them over to a Roth IRA, that will be taxable in the year of the conversion. So that will be added to that MAGI, as we called it, equation. Additionally, if you have lots of high turnover mutual funds. So we'll sit down with a lot of folks, they'll be invested in mutual funds or ETFs, certain ones that really sell a lot of their positions. So if you are constantly selling and buying and trading, that will increase trading costs and ultimately the income and capital gains that those funds throw off. So it may make sense to look at some more tax efficient funds. And finally, when you sell any real estate, if it's an investment property, if you're selling your primary residence and presumably there's a gain above what you paid for the home, well, that will result in a capital gain and that will increase potentially IRMAA. And finally, most folks, how do they pay for IRMAA? Well, if you're enrolled in Social Security, typically it's deducted from your gross paycheck, your gross benefit. And you can also sign up for Medicare Easy Pay online and have the Social Security Administration send you a bill directly to pay for IRMAA as well.
The Social Security Administration sends out a notice every year called the Initial Determination Letter. It usually comes out in the fall, and the notice informs individuals how much their Medicare premiums will be for the following year. So you get your letter in typically November, and it says you're going to be paying additional premiums. What we've not yet mentioned is that Social Security Administration is doing a 2-year look back on income to make this determination. So your income in 2023 will affect premiums for 2025. Income this year in 2024 would affect Part B and D premiums for 2026, and so on. But life is dynamic, so there is an appeal process in the event your income has changed between when you're subject to IRMAA and 2 years prior. The appeal process begins with the form shown here, the SSA 44. You'll first need to indicate which life-changing event resulted in your change in income. Most commonly, this is retirement, but as you can see, there are several options. You'll also need to indicate which year the event occurred and your income in that year. Along with the form, you'll need to provide proof. In the case of retirement, usually a tax return showing the lower income and letter from your former employer are sufficient. Keep in mind that if you're married filing jointly, just one spouse retiring may be enough to make an appeal advantageous. Even if you can't completely avoid IRMAA, you may at least be able to dip into a lower bracket and save some money that way. You'll need to act quickly, though. You only have 60 days to request an appeal. The clock starts ticking the date you receive your initial determination notice. So if you expect to be subject to IRMAA and believe an appeal is going to be possible, gather your SSA 44 and proof so you're ready to go when the time comes.
And that's a great point, Allison. You want to make sure you get the appeal in because it's only 60 days. So most folks don't know that. So some additional ways to reduce or eliminate that IRMAA. So the top part of this is really before you enroll in Medicare Part B. So contribute to your tax-deferred vehicles, your 401ks, your 403bs, your IRAs, and even health savings accounts. Those will help to reduce your modified adjusted gross income. And bear in mind, if you're 63, IRMAA is going to be 2 years in arrears. So you want to really start planning before IRMAA starts to happen. And then really the remaining points here are after you've enrolled in Medicare Part B and you're already realizing IRMAA already, avoid capital gains. So if you have any capital losses, if you're working with a good team, a good financial planner, you should be harvesting some losses in your portfolio if you're able to offset some of those capital gains and minimize them whenever possible. If you're charitably inclined, you can also implement what's called a qualified charitable distribution, which once you turn age 70 and a half, you have the option out of your IRA and your significant other's IRA, if you're married filing jointly, to direct up to $100,000 to a qualified charity 501c3 of your choice. And what's nice about that is most folks, they're subject to what's called required minimum distribution. So what you can do is you can take all or a portion of that required minimum distribution and send it directly to the qualified charity. And that's a great thing because that will reduce your gross income and ultimately reduce IRMAA. Now, you may also have the option of doing a donor advised fund, which is another type of vehicle that you can donate to a charity. You'll need to itemize your deductions, but this is another nice way of donating that can eventually lower IRMAA in an indirect way. And these last points here, Roth IRAs, cash value, life insurance, and reverse mortgage, those are things you can do in anticipation of lowering IRMAA when you are retired and when you are on Medicare. So if you set up a Roth IRA and you do it the right way, you can eventually have tax-free income that will come out and not trigger IRMAA. Same thing with cash value or permanent life insurance. If you set it up the right way and you take loans, it won't be taxable. And also a reverse mortgage can be a nice tool that you can utilize. So we hope you found these tips valuable and useful today. Once again, beware of that IRMAA. It can be rather steep. And until next time, we'll see you soon. Take care.